Have you ever seen this happen? You hear some fantastic economic news, maybe a great jobs report, or a company absolutely crushes its earnings, and then you look at the stock market, and it's just tanking. It feels completely backwards, right? Well, in this explainer, we're going to pull back the curtain on the hidden engine that's really driving the market. And I promise you, it's not what most people think it is.
It's the question that drives every investor crazy. You think you've got the rules figured out, good news equals stocks go up. But so often, the exact opposite happens. Today, we're going to decode why. And the answer has less to do with how much money a company is making and everything to do with one single number that basically governs the entire financial world.
So to get to that answer, first we have to get past what I call the earnings illusion. This is the really common but critically incomplete way that most people think about a stock's value. At the end of the day, any stock's price really just boils down to this simple formula. It's the company's earnings times something called the multiple, which is just a fancy way of saying how much people are willing to pay for each dollar of those earnings. Seems simple, right? But here's the secret. Those two parts of the equation are not created equal. And this is where retail investors and the pros really start to divert. You see, most retail investors are laser focused on that first part, earnings. They're asking, is the company making more money this quarter? But the big money, the institutional investors, they spend almost all their time obsessing over the second variable, the multiple. Why? Because they know the multiple isn't just some random number. It's driven almost entirely by interest rate. And this is really the heart of the whole thing. That multiple, the number that decides how valuable a company's profits actually are, isn't just pulled out of thin air. It's directly, and I mean directly, controlled by the level of interest rates in the economy.
So how does that connection actually work? Well, this formula is basically the math behind the curtain. Now, don't worry, you don't need to solve it, just look at the relationship. The PE multiple is pretty much determined by just two things: G, which is the company's long-term growth, and R, which is something called the discount rate. And that little R right there, that's the whole ballgame.
So, what is this R? It's the discount rate. The easiest way to think about it is as the base level of return investors demand just to bother with the risk of owning stocks. And its single most important ingredient is the risk-free interest rate, which, you guessed it, is set by central banks. Put simply, when the central bank moves rates, R moves right along with. This lays out the entire chain reaction. The central bank hikes interest rates. That immediately pushes up the discount rate, R, for all stocks. Because of that higher discount rate, all of a company's future profits are suddenly worth less in today's money. And as a result, the multiple that investors are willing to pay for that stock shrinks, or compresses, as the pros call it. Okay, let's make this crystal clear with a real-world example. We're going to look at a company whose earnings don't change by a single penny, but its stock price gets absolutely cut in half. Okay, let's start in a low-rate world. The discount rate R is a comfortable 6%. That supports a really healthy PE multiple of 33 times. For a company that earns $10 a share, that gives us a stock price of $330. Nice. Now, watch what happens when the central bank raises rates, pushing that R up to 9%. The exact same company, with the exact same $10 in earnings, sees its multiple get crushed down to 16.7, and the stock price, well, it collapses. So we start here at $330. In a world of low rates, the market is totally happy to pay a big premium for those future earnings. But then, rates rise. That multiple gets squeezed. And suddenly, the stock is only worth $167, even though the business itself hasn't changed one bit. I mean, just think about that. The price got cut in half, not because the company did anything wrong, but simply because the value of its future earnings got discounted more heavily. This is pure multiple compression. And it's the perfect reason why amazing earnings news can be completely overwhelmed by bad news on interest rates. Now, here's the thing. This effect isn't felt equally across the entire market. Some stocks are way more sensitive to these rate changes than others. And the concept that explains why is called duration. The idea of equity duration is actually borrowed straight from the bond market. You know how a 30-year bond is way more sensitive to rate changes than a 2-year bond? It's the same idea. A stock whose biggest profits are expected, say, 10 or 20 years from now, is way more sensitive than a company that's spitting out cash today. We call those future-focused companies, like high-growth tech, long-duration stocks. So on one side, you have your long-duration stocks. Think tech, high-growth companies. All their value is tied up in profits way out in the future. On the other side, you've got short duration stocks. Think banks, energy companies, value stocks. They're churning out cash right now. When interest rates go up, those distant future profits get hit the hardest by that discount rate, making those long duration stocks way, way more sensitive.
And hey, this isn't just a theory. You can see it clear as day in the data. Just look at this chart. The orange line is interest rates. The blue line is the performance of growth stocks compared to value stocks. They are practically a perfect mirror image of each other. When rates fall, that blue line soars. When rates rise, the blue line gets absolutely hammered. That is the duration effect in action.
So let's zoom out. This isn't just some recent trend or something that only applies to the tech sector. This deep relationship between interest rates and valuations is like the fundamental source code that has been running the entire market for over 100 years.
This chart is just incredible. The blue line is the market's PE ratio, its valuation, going all the way back to the 1800s. The red dashed line is long-term interest rates. And just look, the peaks in valuation, 1929, 2000, 2020, they all happened at the absolute bottom for interest rates. And then look at 1981, the peak for interest rates. It marks a generational low for what people were willing to pay for stocks. They are yin and yang. So this is how professional investors think. They spend a lot less time worrying about this quarter's earnings report and a lot more time asking one huge question. Are we in a multiple expansion world where multiples are going up, or a multiple compression world where they're getting squeezed? They know that this one big macro question driven by rates is going to have a much bigger impact on their portfolio than almost anything else.
So let's put it all together. Let's arm you with the exact same framework that the big institutions use to look at the market. This is the key takeaway right here. You should absolutely use earnings to find good companies. That's the what to own. But you have to use your understanding of interest rates to decide the right price, the how much you can pay. Because in a high-rate world, even the best company on the planet can be a terrible investment if you overpay for it. And rates are what determine how much is too much.
If you only remember one single thing from this whole explainer, please make it this. A PE ratio is not just some random number. It is a direct reflection of the current interest rate environment. So the next time you hear a pundit on TV arguing about whether the market's multiple is too high or too low, what they're really arguing about is the future of interest rate. Which leaves us with one last kind of challenging question for you. The next time you're forming an opinion about where the stock market is headed, ask yourself, what's my view on interest rates? Because as we've just seen, if you don't have a view on rates, do you really have a view on the market at all?